Is your investment portfolio ready for the era of low expected returns? In a world where asset yields are dwindling and prices are soaring, we're stepping into a period of potentially reduced returns. This new landscape, fraught with challenges, urges us to rethink our investment strategies. No longer can we afford to chase higher, riskier returns. The need of the hour is a disciplined, process-oriented approach. It's about embracing humility, acknowledging the unpredictability of markets, and exercising patience in our investment decisions. It's about resisting the allure of quick, potentially dangerous gains, and instead adopting a systematic and evidence-based approach. This is especially crucial in a low-return environment where every decision could significantly impact your financial future. Navigating this new landscape requires a shift in focus from outcomes to processes, emphasizing discipline, humility, and patience. In the face of uncertainty, these are the principles that will guide us towards a stable and prosperous financial journey. Understanding the terrain is key in any expedition, including your investment journey. Let's delve into the varied terrains of asset classes and strategies. Imagine liquid asset class premia as the smooth, familiar paths. They're easily accessible, offering potential for steady returns. Then, there's illiquidity premia, akin to the rugged, less trodden paths. They're harder to navigate but can yield substantial rewards for the brave and patient. Style premia is like our compass, guiding us through the terrain with strategies like value, momentum, carry, and defensive. Value strategies are about finding hidden gems, while momentum strategies ride the wave of trending assets. Carry strategies seek to profit from differences in interest rates or dividends, and defensive strategies are like our safety gear, providing a buffer in turbulent times. Mastering the terrain of various asset classes and strategies is essential in this low-return environment. Like any seasoned explorer, equip yourself with knowledge and adapt your strategies to conquer these varied terrains. In the world of investment, alpha is a coveted treasure. But what is alpha, and why is it elusive? Alpha, in simple terms, is the extra credit of the investment world. It's the measure of an investment's performance on a risk-adjusted basis, essentially the cherry on top of your investment sundae. However, alpha is notoriously hard to pin down, often getting mistaken for alternative risk premia, or ARPs. ARPs are returns above the risk-free rate that can be explained by exposure to systematic risk factors. In other words, ARPs are the rewards you get for taking on extra risk. The challenge lies in distinguishing between true alpha and ARPs. This is where the line often gets blurred, leading to misjudgments and misguided investment decisions. True alpha is rare. It's not something you can simply stumble upon. It requires skill, insight, and a bit of a sixth sense. Recognizing the elusive nature of alpha and avoiding assumptions about returns are crucial for making informed investment decisions. The power of diversification is often underestimated. Let's shed some light on this balancing act. Diversification at its core is spreading investments across different assets. This strategy reduces risk by ensuring that potential losses in one area are offset by gains in another. It's a proven method for managing risk and creating a stable foundation for your portfolio. Now, despite its evident benefits, diversification sometimes faces skepticism. Critics argue that it dilutes potential gains. However, it's important to remember that investing isn't a sprint, it's a marathon. Playing it safe and steady often wins the race. This is where mean variance optimization, or MVO, comes in. It's a method used to balance risk and return in a diversified portfolio. MVO encourages us to consider our individual goals, preferences, and limits. It helps us strike a balance between risk and reward. Diversification is a balancing act that reflects individual goals, preferences, and limits and is essential for managing risk. In the pursuit of financial wisdom, discipline and patience are often overlooked. Let's revisit these principles. It's easy to fall into detrimental habits in the world of investment, such as chasing returns and overtrading. These seemingly attractive shortcuts can lead to severe consequences. Evidence-based studies have shown that these habits often result in investors missing out on long-term growth opportunities. Instead, the focus should be on key principles like strategic patience, expansive diversification, and stringent governance. Strategic patience allows investors to weather the storms of market volatility, while expansive diversification mitigates risks by spreading investments across a variety of assets. Stringent governance, on the other hand, ensures a disciplined approach towards investment decisions, keeping emotions and impulsive actions in check. In investment, principles should always hold precedence over immediate profit. Remember, strategic patience, expansive diversification, and stringent governance are your keys to success.